Good morning, everyone. This is Mike Minter, Chief Investment Officer with Financial Synergies Wealth Advisors. And this is our third quarter 2023 market and economic summary. And if you're living in the Houston area like me, it's a great day. We've got some great weather for once, and the Houston Astros won last night, and they're moving on in the playoff series. So that's fantastic. So it's a good day. But let's jump right into it here. I've got some slides and some data, some things we can talk about in terms of what happened in the third quarter and what to maybe look forward to in the fourth quarter. So I think really what defined the third quarter was this really strong start and kind of a rocky finish, unfortunately. So it was kind of this return to volatility environment. So the S&P rose to its highest level beginning in the third quarter, and that was the highest level since March of 2022. And then, but these really fastly rising global bond yields and fears of a rebound in inflation and concerns about a future economic slowdown really weighed on the major indices, and especially in August and September. September, unfortunately, lived up to its name of a horrific month for stocks. I mean, I say horrific. It wasn't horrific, but it was not good. And so that finished off with a down quarter. So the S&P actually finished the third quarter with a modest loss. So not a great quarter, not catastrophic by any means, and still overall a great year. So let's look at what occurred in the quarter, and then we'll spread out to a longer term view. So quarterly market summary here. Let me get my laser pointer here. So for the quarter, U.S. stocks were down about 3.25%. International developed stocks down about 4%. Emerging stocks down about 3%. Global real estate down about 6.5%, and then we had the bond market. Unfortunately, because of the rising yields for this particular quarter, we're down. So across the board, obviously not much to be happy about, but there are signs of life, and we'll discuss that later in the presentation. Real estate especially has struggled simply because of the rising yields and such a capital intensive sector. So not great, but again, there are some positive things to talk about. So if we broaden this out, take more of the long-term view, not a great quarter, but still long-term, if you look at the 1 year and 5 years and the 10 years, still great returns. Obviously, some much better than others. The U.S. stock market continues to be a real bright spot, really kind of kick and tail over this period. But we are now starting to see some life out of international, which is great. From a diversification standpoint, it's exactly what you want to see. And I do think that eventually we're going to turn the corner on fixed income. It's only a matter of time. So let's take a look at, I like to take a step back and just look at year to date in terms of a line chart so we can kind of see the ups and downs here. But we talked about this in the last quarterly review, where the NASDAQ just continues to scream. Now it hit its not all-time high, but it hit its high of the year, up 37% in August. And that was just, what we talked about in our last quarterly review was that really, we knew that was unsustainable. I mean, when you're up 30+%, in half the year still to come, really unlikely you're going to maintain that trajectory and be up, 60+% for the year. So we knew that was going to level off at some point, and it has. They've kind of come back down a little bit, but still 26% year to date, and that's as of the end of September, end of the quarter, is just a phenomenal return, and that's indicative of this continuing kind of domination by tech stocks, which is surprising given last year so many people had written tech off for dead, dead and buried, and here it is, the number one performing asset class. So still fantastic returns for the NASDAQ, even though it has fallen off a bit. Fantastic returns for the broad market, S&P 500, and then the Dow and small cap. Seeing a little sign of life from small cap here lately, which is a good sign, and actually, as I sit here today, it's actually bumped even further up. And the Dow Jones has struggled a little bit. It's 30 stocks, very value kind of oriented. and simply doesn't have as much of the tech participation there, and that's indicative of a 1% return year to date through September. So let's kind of flip the page here to sector return. So I like to outline this to kind of see the tale of two cities, and this is pretty typical throughout a given year. Things will change, sectors will come in and out of favor, kind of that sector rotation. And so what we're seeing here is technology obviously leading the way, communications, a lot of tech in this communications sector here. So really dominated by the tech and communications sectors, and not so much down here. You have your more economically sensitive areas, financials, healthcare, real estate, consumer staples, all kind of taking a back seat in terms of the participation this year. But here's all rolled up. S&P 500, 13.5%. This is actually as of October 11th, so a little bit beyond just the third quarter. Wanted to give some more up-to-date returns there. So let's start talking about the economy. This really was, for the third quarter, and still, as I sit here today, all about interest rates and jobs, and probably will be that way for quite a while. What we're seeing is kind of a continuation of what we talked about last quarter. CPI, if we follow this here, going back to the third quarter of 22, fourth quarter, and then into 23, we are continuing to see CPI, which is inflation, come down. This is exactly what we want to see. I think the Fed has made some good progress. It's not all the Fed, obviously, but I think that overall it's hitting its objectives of bringing this inflation number down. So as it stands right now, inflation in the second quarter was right around this 3% rate, which is great to see. A pretty significant drop off from where we've been over the last year or so. And then we don't quite know where the third quarter is going to shake out. There will be revisions, but it did tick up a bit to about 3.5%. We don't know the final number on that, but assuming it ticked up, that was a little bit of a surprise, and I think indicative of some of the market jolts here as of late, where it was the impact of maybe a tick up in inflation was jarring to the market, and so it led a lot of people to believe that maybe there's another rate hike coming this year. We don't know. Things are very in flux, so it's impossible to say. But what they're predicting here is 3.3% fourth quarter, and then dropping again in the first quarter of 24. Exactly what we want to see. Assuming we can keep this pace, that's all good news. Unemployment remains a real strong spot here. This is really incredible, these low unemployment numbers. There is a forecast of these ticking up, which is indicative of probably an economic slowdown. But right now, they've just been incredibly resilient. So, and then we have some rates down here. I won't spend too much time on that because we're going to really kind of dig into some of these numbers in these later graphs. So inflation, CPI, still on a downward path, but very resilient. They've been able to accomplish a lot. If you look at where we were coming out of the pandemic and that environment, we were really spiking, really too high, too fast, and that was really the scare there. So they brought that down considerably with their campaign to raise rates and fight inflation. You can see this minor tick up here just in very recent month, and that is what was kind of spooking the markets a bit. If they can get that back under control, then I think we're in good shape. Unemployment rates, this just continues to be surprisingly strong. But I think what you are starting to see here is this little bitty tick up here very recently, which is counterintuitive. You think you want to see low unemployment, and you do, but sometimes too low is not a great thing for the economy and inflation. So we actually want to see this tick up here. So that's actually good news, and it's moving in the right direction there. Same thing with wage growth. This continues to cool off. It's very difficult to get inflation under control and consumer spending and all those things when you have out of control wage growth. And so, which is kind of what we saw, it really just spiked up astronomically after the pandemic, and now it's kind of coming back down to earth. We want to see that. We have to have that for this inflation environment to really be contained. So good news there. Interest rates, yes, continuing to march upwards, but we are starting to see signs of life more on the longer end, and we'll talk about that in the yield curve. But they continue to move up, which is obviously bad for existing bonds and prices being inverse. But this is not what we're seeing here is more of a leveling out and bringing up the rates on the long end, which is actually a good thing. That's what we need to see for a normal rate environment. So we'll talk more about that. The 10-year sits at about 4.66 and the 2-year about 4.96. So still flip-flopped, which is not great, but we'll talk more about that. So leads us right into the Treasury yield curve, which I talk a lot about because it really tells you a lot about the current economic environment and also just the bond market. So what we're seeing here, this latest, is this darker line. It's good news because while subtle changes here, you can see that the longer end of the curve is now showing signs of life. So meaning you're going to get paid more to own these longer dated bonds, which is exactly what you should expect in a normal environment. So what it's happening is the yield curve is still obviously inverted. So you're getting higher yields on the short end of the curve, which is opposite of what you want to see in a healthy environment. But this yield curve is starting to become less inverted. It's less dramatic, these later numbers, as compared to the last quarter, which is this lower line here. So you're seeing this longer end tick up in terms of rates and the yield curve becoming less inverted overall. So good sign there, more positive news, although subtle, sometimes hard to identify, as moving in the right direction. Fed funds rate. So this is what we talk about a lot because this is kind of the consensus of the Federal Open Market Committee and the participants. So we know that still what they are seeing is that we are really close. We don't know yet, but we are really close to probably peaking on their rate targets. Once that occurs, it's inevitable that at some point there will be a leveling off and a lowering of interest rates, possibly in 2024. That is kind of the consensus right now. We shall see. Things change a lot here, but if that's the case, that is good news overall, not only for the economy, as it's inevitable at some point the economy is going to slow down, but what they're going to do is they're going to begin to lower rates to kind of boost economic growth and activity, and bond prices will respond in turn by increasing. And so what you'll have in bonds is a better yielding fixed income portfolio with price appreciation. And I've talked about that in some other articles, but that is kind of where we are and where we see things. So the current business cycle, I thought I would throw this in there. I didn't have this in on the last presentation, but I thought this was really interesting. We are now, we're in one of the longest business cycles in history here. These numbers down here at the bottom are quarters, number of quarters. So this is now a 15-year business cycle from the financial crisis that we are in. Now you can see we took a real dip here in the pandemic. This is the pandemic, so this 2020 area here. This wasn't even enough to derail this business cycle. This is one of the strongest business cycles we've ever seen. Even the pandemic wasn't enough to break this. It was such a short-lived downturn, so minute, that we rebounded crazy, straight up V recovery and never missed a beat. So we are still in the current cycle. So there's no question that at some point, business cycles are what they are. You're going to contract, and then you're going to start the whole process over again. We just have not gotten to that serious contraction point. And right now, even a recession, the big R, it's in conversations, and we may find out that the NBER, the economic kind of gurus, may even declare that this time frame we're in right now is a recession. We don't know. We never know until after the fact. But right now, there's really no serious talk about a major recession. It could happen, but still, with unemployment where it is, and the really still decent economic metrics coming out, a recession right now is not imminent. Now, at some point, of course, we'll pull back and we'll have a recession, but it's just really not indicative of the metrics we're seeing right now. But of course, yes, we will have a contraction. The question is, how deep, how bad will that be, and can they really achieve this quote unquote soft landing? So we'll see. But I'm more optimistic about that, I think, than probably I have been in a while. Obviously, things can change, but that's kind of the environment we're in right now. So real quick, just a plug. If you are not an existing client, I won't go through this in detail, but why would you choose Financial Synergies? We would love to talk to you guys. We're trusted advisors, fiduciaries, comprehensive experience, transparency, total wealth management, and a diverse set of portfolio solutions. I'll leave this here for your light reading. I appreciate you letting me do that. So this is our contact information should you need to get in touch with us. As always, we are here to speak with you about any of your financial planning and investing needs. If you are a client, as always, all you have to do is reach out, and we would love to talk to you. So I hope this helped to shed some light on the third quarter of 2023, and we'll have much more to come on this as we report on a weekly basis and then into next quarter. So I really appreciate it, guys. Thanks so much, and we will see you down the road.